Good evening, everyone. Thank you so much for joining us on our webinar this evening. Do you know, I wish, by the way, I'd like to introduce you to Brenda Mooney, who is one of New Zealand's top mortgage brokers. Brenda, do you know, when do you think that we're going to be able to see people face to face? When do you think this is going to happen?
Well, I don't know. I feel like this is the new way of the world at the moment. It just with our red tape everywhere, it just feels impossible people are barely getting on a plane and flying to Auckland or Christchurch or. Yeah.
I know, and I've got to say that I'm probably oversharing here with everyone, but this is a very safe circle. Sitting down doing these webinars and presentations, I'm sure my bottom is getting bigger and bigger and bigger. And I really would like to be moving around the country and talking to people, because I'm getting a bit tired of this, stuck in my library at home for these sorts of presentations. But thank you everyone for joining us tonight. We've got more that are coming on. Do you know, I'm going to have a little bit of a rant. I'm going to have a rant at the government. I'm going to have a rant at the stupidity of the banks. I'm going to have a rant at everything. So I apologize if tonight you're going to get really sick of me with my view on what's out there at the moment. But this evening we're going to talk about not only how difficult it is to get lending from the banks, but also what we can do to try and counter that as well. So it doesn't matter if you're a first home buyer, if you're a homeowner that is wanting to refinance your home, or you're an investor. I mean, one of the things that I've always done is said that I want to always give information. I don't care who it's to, and if it gives you something that is going to help you, then so be it. And whether you come to us or not, whether you are homeowners and you don't want investment or not, it makes no difference to me. What is important is that you get an understanding of what's going on in the market and how it affects you and what you can do. Because one of the other things is that it is very frustrating to give you tell you what all of the sad story is all about and not give you any solutions. Well, that's something that I won't do. And that's one of the reasons why we've got Brenda here this evening as well, because Brenda, being one of the top mortgage brokers in the country, we spend a lot of time looking at our clients' situations and how we can come up with a cunning plan. And of course, over the last few months particularly, we have seen almost 2/3 of borrowers being turned down. And whether that is borrowers for homes, probably for first home buyers, that percentage, do you agree, Brenda, is probably a lot higher?
I think it's getting so hard. I think the banks have just gone too far with all these changes and, what it means to get loans. And I think the taps are off pretty much for first home buyers if you don't have a 20% deposit.
Yeah.
So that's just going to be difficult. Yeah. And
of course with children. So we'll go through that in a little while. But we're seeing this absolute ridiculous situation at the moment. I mean, we're a laughing stock in the rest of the world. I mean, I read online the Evening Standard, and it's even being reported about how crazy our new lending rules are. So let's go back and just start from the beginning. So before Christmas, we were aware that there was going to be new regulations, and that is the Triple CFA. So Brenda, do you want to just very quickly go through what that means?
Okay, yes, so Triple CFA, it stands for Credit Contracts and Consumer Finance Act. And that has all come into place in force in New Zealand at the banks from the 1st of December last year. So it's all fairly new. And it's really just all about really looking at compliance and looking closely really at affordability and fit for purpose loans and that kind of thing. And the big changes that we've seen is, they're just scrutinising and going through bank statements and looking at everyone's spending and looking at that and looking at what they have got left over at the end of the day, and can they even afford these loans? I mean, it's unbelievable, really, what we're hearing and what we're seeing. And I believe they are approving about 23% of loans that get submitted. And I imagine there's many brokers and many other bankers where they don't even get to that point. They're not even getting as far as getting an application to the bank. They're just not going ahead because they're just saying it's just not affordable. And
So, I mean, let's get this back to how it was supposed to have, how this came about. So basically, once again, I've just got to pull back and not get angry. But there was this, this started because there was this protection, this need, supposed protection for those vulnerable people that were borrowing and being more than they could afford and being taken advantage of, and predominantly by third-tier lenders, not necessarily by second-tier lenders, because actually second-tier lenders are a borrower's friend at the moment. And as I said, we'll go through that in a moment. And so we're talking about a very small number of the population. Now, what has happened is, and we saw this when the anti-money laundering laws came in, there's this huge knee-jerk reaction. And before you know it, we've got mainstream banks that are now looking at and worrying about the sort of fines that they could have because of their lending. I mean, Brenda, what sort of money are we talking about?
I think it's significant. Like I've heard figures of like the banks could be fined $200,000 for breaking rules or not being compliant and all this sort of thing. So it's really huge. And you've got to think, to get through a bank loan, there could be 5 or 6 people involved. And any one of them could be breaking some sort of rules or something in the fines. I think they're all living in a complete fear that something's going to go wrong and something's going to happen. And I think the fines are absolutely huge. And it's absolutely massive.
And this has come about, I mean, let's be realistic about this. This has come about because of a very tiny minority that there was a concern about them being taken advantage of in that third-tier lender. And some of those lenders that aren't even for mortgages, we're talking about some of those short-term, and I'm not going to use the names here, but are giving loans that between payday and whatever. So what's happened is that the banks have now taken this hugely overreactive step. My view on this is that, of course, we've now got the government involved. And here's the other thing. We're supposed to be a country that's helping first home buyers. We're supposed to be looking at more housing. We're supposed to be looking at why we have penalised investors so that first home buyers have a better shot at getting established housing. And yet this is something that has literally put the brakes on for first home buyers. Because when we look at some of the criteria, it's telling us that they will never, ever, you have a few children, you've got a household income that's under 150, you've got some debt, that you will not ever get a loan. And so what we're seeing here is something that is unprecedented, and yes, the government should get involved. And in fact, now that there are a lot of us that are putting submissions into Parliament about the absolute ludicrous situation that we've got at the moment. So sorry about that. I've done my rant. So that's the Triple CFA, everyone. Now, what difference has it made? Okay. Previously, when we were looking at clients and whether they could get funding, we had a rule of thumb. And Brenda, if you want to go through what that rule of thumb is, otherwise I'll just keep on talking and talking and talking.
I mean, I always, used to think, gosh, if someone earns less than 100,000 and they have a family and they have a mortgage already, it's probably unlikely they could afford to buy another property or a rental property, something like that. But, generally speaking, if it's a family and you're earning, 150,000 combined incomes, and you had a small mortgage or, $350,000 mortgage or something, some sort of loan, you generally would be able to afford to get another property. But these days, it feels like it needs to be another 100,000 on top of that. I find deposit and equity, that kind of side of it's not really an issue because the value of properties has gone up so much, but it's completely the servicing side of things that's really just had so many changes now. So I think, it looks a lot different to what it did look like, just a few months ago.
Well, that's exactly right, because I last year or at the end of last year, we had a dozen clients that had got pre-approval up to 900,000. And when these new rules came and regulations came in and the banks re-looked at their scenarios and their situation, they were even getting turned down for 600,000. That was heartbreaking.
Yes.
Yeah, it was absolutely heartbreaking. And these are families. These are people that have worked their whole lives, have built up what they've got in their home, and have a reasonable income. It's the country average or above average income. And yet finding that under these new regulations that they no longer can get a mortgage. So what we're seeing now is that what we have to look at a new we have to look at a new scenario, which is, and this is, sorry, but this is at the moment, because this is how ridiculous this scenario is. I believe, and I think, talking to you, Brenda, as well, that it can't go on like this. First of all, the banks aren't going to accept that they're going to only have 22%. So basically, what is that? 78% of their income go just like that. Banks aren't going to do that. That's not what they're around for. And we're going to find that with this upsurge at the moment from the complaints to the ombudsman. I mean, we're now seeing quite a groundswell, aren't we, to what is happening at the moment.
Yeah, there's a lot in the media, a lot of petitions going around. I feel like the government will have to listen and will have to review things. And, people can't carry on. It's going to affect just too many in New Zealand. No one can do anything. People can barely downsize their home. They won't even get the loans they've got now. And you would expect, that you would be able to, do better than that. But it's just going to put a grinding halt on everything. And as you said, Nikki, the banks just simply aren't going to make any money if they're not approving all these new loans. I feel a little bit sorry for the bankers that work there. It's not their fault. They're having to process these loans. And tell me about how much people are spending on Uber Eats and all the breakdown of everything. But I mean, it is really just put under the microscope at the moment.
And it is, this is not also an urban myth. And I'll give you an example. We've got one of just one of our clients in his mid-30s, earning nearly 200,000, home, and he's got a tenant. He's a single guy. He's living his life, and he was turned down by a mainstream bank because he used Uber Eats 4 times a week. And why shouldn't he? Why shouldn't he go out? Why shouldn't he go out eating? Why shouldn't he have the life that he has? And to ask women whether they're going to have children in the next 4 to 5 years is absolutely appalling, because once again, that has gone on for centuries, and yet we've still managed to have mortgages as a couple and still pay those off. The other thing that it's affected is clients of and borrowers of a certain age. Now, there was always a prejudice to borrowers that are in their 60s, but Brenda, we're seeing that go down even further, aren't we, at the moment?
Absolutely. Some banks are just working out how many years there are to go until you reach the age of 65. It may be 10 years for some people, 15 years, and they are basing their loan assessment on, say, a 15-year term, because that's when they're 65 and they could retire and may not be earning their income and have their jobs. So, if you wanted to buy a property and you're thinking, oh, might just live here for 5 years and then we'll sell it and retire and move. Well, you just can't get loans like that at the moment. It is very up and down, and it is quite different between the banks. So some banks will still approve loans for people in their 50s and 60s and no problems at all, and then some are not. So it is quite a variance at the moment with anyone that is over 50. It has become harder though.
And that's one of the reasons why we've got to look at, I think you said before that it's not with a lot of people, it's not the equity, because of course the rate that housing's going up and the value now on your homes, which is, it's great to be seeing that your home's worth more. But the trouble is, what can you do with that equity? You can sell your home, that's fine, but you've got to live somewhere. And what we're seeing as well, and I've been talking to a few people that are in their early 60s, and it's basically, well, what can we do for you today that is going to give you a mortgage today that may be more modest than what you would expect, but it's using some of the equity that you've got today, because even a modest return is better than no return. And it's what we can get from the banks for you. Now, the situation may change, and it probably will, but it doesn't mean to say that with our ages that goes ticking on, that they may loosen how they give approvals. But there's always been this prejudice towards age as well. So that's something that we've got to be aware of. And some of the strategies that I've been putting in place for clients as well is saying, okay, we understand this scenario. It may be too late in a year or 2 years just because of your age. But if we can get you something today that is going to utilize a little bit of the equity in your home to give you some sort of modest return, even if it's 250,000 modest return in 8 to 10 years. And of course, we're always very conservative. Take it, because this may be your last window of opportunity. And what makes
it's still a lot of money, 200,000, like you were saying, it's just a modest thing, but it's a lot of money. It's still good.
No, you're absolutely right. It is a lot of money, and that 250,000 will make a difference to people's lives, absolutely. And if you can do it in a way that you don't feel it, and one of the things that we sent out recently was information on hotel rooms, which have a guaranteed rental for 30 years. Now, under 300,000, yes, I'm modest. And I say this, I'm not going to walk away from it. a modest investment. But if that's all you can get from the bank against your home or another property, get it. It's a guaranteed rental. And as you said quite rightly, Brenda, you know, we're so used to thinking in hundreds and hundreds of thousands that we forget that actually that's more than most people, New Zealanders, earn in a year. So, and not a bad return, you know, two years income for doing absolutely nothing through that time. But, you know, I've been looking offshore for property, and this is what makes me so angry as well. You go to the States, and as an expat and someone at my age, and I'm not going to tell you my age, but I think you can all guess it by now. Yeah, I'm not going to share that much with you. I could not get a mortgage here, but in the States, as an overseas investor, they will loan no matter what age you are for 30 years. And whatever you want to say about that society and that market, I mean, this is something which I totally believe in, because people are working a lot longer, and of course a lot harder. And what we're going to see, and this hasn't started yet, but because we've seen the rise in the prices and the values of our homes and the prices of properties, we're buying properties now, you know, in the three or four major cities in New Zealand, and they're six and seven figures. So you tell me, if you're 45 and you've got an interest and principal, by the time that you're 65, are you going to have your home mortgage paid off? And I can tell you right now, unless you make huge sacrifices, you don't go on holiday, and you compromise your life, the answer is no. At the moment, it's just under 50% of people, New Zealanders, will retire with a mortgage. I can see that growing and being quite a lot more. So sorry, Brenda, I sort of.
I think for anyone who is of age, meaning just 50 or over, trying to get loans, and that if it was for an investment, if they stop working at age 65 or 70, whenever, they can sell that property at that point. They're not going to keep it for 30 years, but they should be given 30-year terms, because they've got lots of options. So there's so many exit strategies and ways of repaying that. You're not going to retire with all these mortgages and you can't afford to pay them. Of course,
no.
And you'll still have made a huge profit. So that, of course, is a retirement plan, but it's just looking less unlikely at the moment. But I think we do have some options anyway for people, not just these main banks at the moment. If they're going to be like the way they are, there is certainly some alternatives.
And that's what we're going to talk about as well. But one of the things that you just brought up, which was very interesting, is other strategies. Now, this is where we come in with our clients, and I'm going to give you an example. So we've had clients that over the last 5 years have bought into Hamilton and into Christchurch. And let's just talk about the ones that have bought houses. So we've got in Christchurch, for instance, clients that over the last 5 to 6 years bought houses that were in the 500s to early 6s. Now, those properties are now worth in the 800,000 and 900,000. So here's one of the things that, and it's the same in Hamilton as well. We've got clients that bought, and I think you did as well, didn't you?
No,
Brenda?
Yes, I did. I bought in Rolleston and in Hamilton, yes.
And the one in Hamilton you bought for what, early 6s? And
no, I think it was 525.
And that was like a 3-bedroom?
4-bedroom house, a 170 square metre home. Yeah, nice, really nice looking house. Yeah.
And so what we're seeing now, that those properties in Hamilton are worth about 1.3, 1.4, the ones in Christchurch up to 850, 860 into the early nines. So here's one of the things that we're saying to our clients now. I always said, take a long-term view, 10 years, long-term view, but we didn't, we knew that there was going to be growth. I'm always very conservative, but what we're seeing in that 5 to 6 years is enormous growth. Now, if you're an investor and you sell a property within 5 or 6 years, you don't pay tax on the profit. So one of the things that we're looking at now is saying to our clients, right, you've made all of this profit, 5 to 6 years, you're not going to be paying tax on it. Why not sell those properties now, take some of that, do what you want to, pay off some of your own home mortgage, and why not put that as a cash deposit on another investment property and do the same thing over the next 5 to 10 years and actually get the access that return straight away. So these are some of the things that we want to be talking to our clients about, and you should be talking to us about as well. But so let's go back to addressing how you can look at getting a mortgage and what we do to think outside the square as well. So addressing these issues. Brenda, we've got a lot of clients that have bought off the plan and over this year are going to be settling. So what is one of the strategies for our clients that you've been talking about to look at getting that loan? Because as we know, when we always ask our clients and to get our clients pre-approved, but it can obviously that pre-approval only lasts for a certain amount of time. So if we are now looking at a year down the track, we don't walk away from you. This is something where in a situation like this, where it's very, very good that you're dealing with the right sort of people. So, Brenda, some of the strategies that we've got, and while you're doing that, I'm going to have a sip of wine. Sorry.
Oh, good. Yeah, well, absolutely. So, I mean, Nikki, you're very good, your company. You always try to minimise anyone's risks. And for most people, the best thing to do is to get a pre-approval at the beginning when you sign up on these properties, even though they might be a year or 18 months or some 2 years, in the big buildings, it could be 2 years away, but you've shown an effort, we've gone to the bank, we've asked for pre-approval, and then later on, towards the end of the build, we do need to relook at lending again, as the window for approval is not open the whole time. So the banks are going to look at your income, employment history, that kind of thing, any savings, spending habits, your credit score, all that kind of thing, assets and liabilities. But we do, I have had nobody that hasn't been reapproved, that we approved off the plans at the very beginning, even with all these Triple CFA changes. Everybody is still getting approved. And I believe the banks will honour the approvals, even though they were a year ago or 18 months. But, we do really do our very best. And if something has changed drastically, like you're not in your same job, maybe you don't have a job, Propellor are fantastic, I can say, and would look at on-selling the property for you on your behalf before settlement, so that you're not actually settling on the property. You've gone and there's always been like a profit that they've made as well. So still managed to clip the ticket and not had to settle because of some sort of unforeseen circumstances, and they couldn't settle. So, I do think that's an amazing feature about your company, Nikki, and what you do to support your clients, because something could change, and it's one of the risks that you take when you do buy off plans, but you really minimise that risk by offering to support them right through the whole process.
I think that's part of it, isn't it? It's all very well in the good times. It's the knowledge in the times that aren't so good, and the unforeseen as well. One of the other things that it sounds very flippant, But with the banks at the moment, when they're looking at your spending, they're looking at 3 months' income, aren't they? They're looking at your cash flows and your bank statements for 3 months. So I know that you give good advice on that as well.
Well, that's right. And they are looking generally at the last 3 months. And then there's often circumstances that, we've just had Christmas, for example. So people's spending is up. And that is a reason, and we can justify that, and we can explain that actually, okay, so going forward, this is going to change, or that's going to change. And so we can itemize some things on the statements and go through, but, do look at things quite closely. There is other bank options as well. There's a couple of second-tier lenders that are offering residential rates. And they are a little bit higher. They're probably 0.5% higher than the main banks, but that is possibly an option for quite a few people as well, and becoming more and more popular.
And I don't think, I mean, there used to be a stigma attached to that, but there's not, because if we're talking about 0.5%, remember, we're not talking about forever. We're talking about using a tool to get us somewhere that we is going to give us a better return, or a greater rewards, and it may just be for a year or until the banks change their lending criteria. And I've done this quite successfully myself, along with, and Brenda does all my organises all my borrowing for me, that yes, sometimes I've needed to have a second tier lender, but the rewards at the end of it, I would have missed out if I hadn't had a second tier lender in a couple of instances. I would have missed out on something like $2.5 million worth of capital gain, and for the sake of 0.5%, which actually in the overall is not a great deal. So it certainly is a tool, and it's not. You see, the second tier lenders are regulated as well.
There's nothing wrong with them at all. I think people are worried and think, oh gosh, this is a really bad thing, but it's hand on heart. I would honestly, personally have my home loan with them as well. They offer residential home loan products. They're a lot more flexible than the banks, and they're very good for a certain time frame, or even if you're permanently there. It is not a lot more at all. They're very good, as I say. It's just becoming more and more popular. And some people are newly self-employed, or, they do lend more than the main banks as well at the moment. So if it's going to mean me buying this property or can't buy the property, well, I'm definitely happy to take the 0.5% higher and take the property,
And as I said, it's remember that this is a strategic decision as well. You've got to look at the long term and the long term rewards on it. Just going back once again to the banks and these 3 months of statements that they look at, Brenda. I know that once again this sounded quite flippant, but I know that you've said this to some clients that, okay, the reason why you've been turned down, or you could be turned down, is that you do have Uber Eats 3 times a week, or you have, as we've read in the newspapers, someone had gone in and bought some Christmas presents. One of the things that you've said is, okay, it's touch and go under the new regulations, but what we need to do over the next 3 months before settlement, or before you are going to get a top up on your own home for whatever reason, is to look at that spending. And this is why it's good to be working with a broker as well. I always say this to my clients, it's amazing how little some banks actually know themselves about the regulations and certainly around lending for brand new property. I mean, I just get floored every day with the ignorance. But one of the things that you've said to them, Brenda, which is quite true, for the next 3 months, you're going to have to bite the bullet. And we want to see clean bank statements.
Absolutely. And I think it's something everyone should really be mindful of at the moment. Well, we've got these rules here, and it's not thinking, oh, yeah, we earn 200,000, it'll be fine, we'll get that loan, it's no big deal. But they are looking at everything you spend, and discretionary spending. You would think if you didn't have the money, then it shouldn't matter. If you haven't got the money, you don't go out for dinner and you don't buy all the coffees and the Uber Eats and all that holidays where you don't go. But if you do have the money, often New Zealanders, that we all just spend our money. We're not great savers, but people are going to have to make sure that their bank accounts and bank statements make things look like you can easily afford these loans and actually put aside money into a savings account, and be making sure that we are really looking and focusing on everything, because they ask for bank statements from your credit card, your business account, your personal accounts, everywhere. So it's not like you can hide any of the spending. Everything goes through for a check. They've got automated computer systems that just put everything into silos, can work out exactly what you're spending every single dollar on. Amazing.
Yeah. It's actually, and it's, as I said, it's overkill.
It is overkill. It's all based on spending habits. And you can see why the government would want to clean up the loan sharks that have been charging people 250% from a payday loan from one pay to another, or, trying to encourage people not to go out and get car loans and not to rack up credit cards and all that. I understand all that. But to say to someone that, you shouldn't go and spend so much on coffee, which comes up a lot, I just tell my husband that he spends far too much on coffee. But what we're seeing here is these organisations telling us how we can spend our leisure and what we can do in our personal lives. And as I said, that's for another time. But I mean, the other thing is that we've found coming up as well, that we've got clients that have got pre-approvals for lending. And as you said quite rightly, those pre-approvals, for 3 to 6 months or whatever they are, they will honour those. And so the other way that we can look at it is how we can find and get investment property that is brand new but ready in a short period of time. And a little bit later, I did this before Christmas, but I'm going to go back and talk about a property that is going to be ready at the end of March. So that's another thing, isn't it, Brenda? I think it's the good you need for you and your company. You've got quite a variety of properties because everyone's situation is different. Some people really need to settle quite quickly, so these sorts of properties are going to be really good. A lot of people don't want to wait 18 months before something's ready. They get quite nervous about it. But for some people, having something that is ready in another month or two is just perfect. And it's, a really good option. The loan's not going to expire, as you say, and it just means there's no worries or, hesitations about getting the lending again later on if people are super nervous about it.
Right. Now, I want to just talk about, we've only got, I didn't want this to be a long and protracted situation, but I wanted to talk about, and just very quickly, I've got, here's a question. Have you personally found a real problem now, Brenda, trying to get finance for your clients? And well, we know the answer to that, don't we?
I haven't. I think most people have. Everyone, touch wood, I've managed to get finance approval for again, and I haven't had anyone so far that I haven't. I have had some people that have changed their minds, circumstances have changed, and we look at on selling them. through Propeller, but so far, no, everybody has got the loans, but we all do need to be a little bit worried and a little bit more careful with the spending, with what the current regulations are.
Right. Okay, so now with that, let's go back to brand new property and why brand new property, because in fact, the other thing that we're seeing is that clients are getting a little twitchy with the interest rates. And of course, I know that if you've come to see me and you've spoken to me personally that you're sick of me saying this, but when I started, my first home loan was 21%. Now, hopefully we'll never get to that. We'll never get to that again. But when I started in this industry, the interest rates were 9.7%, and yet we still had a huge amount of investor clients. Of course we did, because it came down to exactly the same issue, that most New Zealanders do not have lump sums in the bank, but they do have equity. And there's only one thing that you can use equity for, and that's to go to the bank and borrow for an investment property. And also at 9.7, the interest rate on money in the bank still wasn't as good as that. And of course, we've still got this scenario today that what is the interest on cash? But so let's just go back to some of this brand new property. And we've actually seen, and once again, I'm horrified that there are some mortgage brokers that still do not even themselves understand, let alone going to a bank and telling them and giving them guidance, as Brenda does, about how they look at brand new properties. So just to reiterate, brand new property, 20% deposit. Brand new property, you can sell that if you have to after 5 years, and there's no tax on the profit. The other thing is, and Brenda, if you want to go through this, which is brilliant, and some of the banks do it, and it's dependent. See, a lot of this as well with the properties that we talk to clients about. Some banks like certain properties, some banks don't, and it's nothing to do with the property itself. It's just their criteria. But we've also got something called it's a new build interest rate that a couple of the banks have, which make a huge difference. So we've got interest rates at the moment that if you want to go through, Brenda, what the floating in 1 year is, and then if you could just talk about this new build rate as well.
Yeah, sure. So fixed rates are really sort of from 3.5% for a 1 year fixed rate to 4.25 or so for 2 years, as an example. But a couple of banks now, ASB and ANZ, have these new build special deals. So once the house is finished and built, or apartment or townhouse or whatever it is, once it's built, you can go on a heavily discounted floating rate. It's nearly 3% off the floating rate, 2.76% off at ANZ. It brings that floating rate down to 2.03%. So you can have this loan for 2 years. Obviously, a floating rate can change, but it's always going to be significantly cheaper than whatever the fixed rates are doing at the time. So it is slightly harder to budget, but I just think with the interest rates that cheap compared to the fixed rates, it's a complete no-brainer to have these special deals that ANZ and ASB are offering for 2 or 3 years, and then you just would go back onto normal fixed rates. So that's what they've got going at the moment. So most of my new build clients are going on these special rates, which is incredibly low and very good. I think it's definitely a cost saving over the next couple of years. It could be $15,000-$20,000 you're saving. It could be hugely significant.
It's a huge saving, but then again, if you've got something today, especially if you're looking at Auckland, Hamilton, and Christchurch with the sort of growth that they've got. Not only are you saving that sort of money, but you've got the enormous potential capital gain for that as well. Okay, I'm going to pull up a property for us to look at and to talk about, Brenda. If we, can you see that? Can everyone see that? You're able to see, I'm just about to, okay.
We can see that.
Can you see that? Yes?
Yes, I can see it, yep.
Okay, great. So here's a property example in Papakura. Its expected completion date is April, May 2022. A very good size property. It's amongst all of the shops. It's in a very good area of Papakura. We've got a few clients that live in that area that really like the property. So it's in East Street, which is in the residential. It's free day and night parking. They come with blinds, dishwasher, air conditioning, and they're a very, very good build. So it's a new build. It's going to be ready soon. And if we look, 2 bedroom, 1 bathroom, floor area 72 square metres, a balcony of 6 square metres, entry porch. So a very, very good size. And there are car parks available to purchase. So the purchase price is $659. The rental appraisal is $500 per week to $550 per week, furnished. So if we go through this and the cash flows, Brenda, purchase price $659, furniture pack $15,000, deposit is $65,900. Brenda, do you want to just go through how you organise that deposit, please?
Yeah, so it's all done in 2 stages, even though it is nearly finished. But we just need to borrow the first initial 10% deposit, and then also I get a little bit extra for buffering costs, just to take care of any costs for that property whatsoever. So it could be the accountant, the solicitor, a valuation that the bank might want, anything, the accountant's fee, that kind of thing. So it's all covered and it's run like a little separate business. And I would also get at that point that $15,000 that you'd want to furnish it, because I do find 1 and 2 bedroom properties, apartments or townhouses, seem to rent out a lot better. I've always furnished mine, and you end up getting another $50 a week in rent, and it costs about, well, I'm just going to work out that furniture cost. Bear with me 1 second. Per week is $5. So in comparison to the extra $50 a week rent, it cost me $5 to borrow the money. So it's definitely worthwhile. So yeah, at the beginning, it's the 10% deposit with the little buffer and the furniture. And then at completion, we need the balance of the lending. So it's done in 2 stages. And I would get you, I think ideally people would be going on that 2% new build floating rate.
Yeah, it is there.
Really good.
And that's for 2 to 3 years. And then, of course, what we've done in the cash flows is put it up to 4%.
Yeah.
It's an investment, so it's interest only on the loan. The property is cash flow positive immediately after all the outgoings by $77 per week in year 1. And that's, of course, is on 100% borrowing. Potential value after 10 years, if the property doesn't double for 12 years, is 1.237. And the potential capital gain on that property over 10 years, if the property doesn't double for 12 years, is $553,000. So, it's cash flow positive immediately. It's a reasonable spend. And of course, it's in Auckland, which is, to get into Auckland, into Greater Auckland, under $1 million. I always say to my clients, you have to have something. You have to have something in Auckland, because it's an investment, and that's where you're going to get the greatest rentals. And so that's an example of something that's 3 months away, pre-approvals, and with that sort of return. So there are ways of getting around it. And as we said, don't feel nervous if we have to get you a second-tier lender to start with, because as Brenda quite rightly said, for the sake of 0.5%, you could be missing out on a potential capital gain of over 500,000 in the next 10 years. So remember, it's a business decision, not an emotional decision in that respect. So we've come to the end of this. I'm sure there must be some questions. Please, if you've got any questions, if you want to send them through now. I can't see any. I don't know if there's no open questions. Oh my goodness. It's always a good sign, or is it? I'm not sure. Is it? But if you want to find out more about these properties, obviously, sorry, let me just, here's who you contact. Call us on 0800 81 81 91, info@Propeller Properties, or contact your senior consultant. And of course, when you speak to your consultant, they'll give you Brenda's contact details as well. So, I mean, I think we've got, someone's just asked a question. How long can you have interest-only mortgages? Well, now that is a very good question, because, go on, Brenda, let's tell them the bank's view, and then let's tell them the reality.
Well, typically they would offer a maximum of 5 years, and that's what they would generally offer up front. I've had many people where we just basically reapply after the 5 years and ask for more interest only, or we could swap to another bank and get more interest only elsewhere. So, I mean, even if you, some people after 5 years, to be honest, are probably happy enough chipping away and doing principal and interest repayments. Some people would rather just continue on interest only. So, look, 5 years is a typical answer and an approved, term that the banks will offer. But generally speaking, if it's affordable and you can afford a shorter term on that loan, we will get more interest only from the bank. Yeah,
but one of the things that I always say is, why do principal and interest on this? Because if you want to pay one off, get two and then sell one in the future to pay the other off. And it doesn't compromise your day-to-day cash flow. I come back also to those clients that I can see that we've got clients that are in our attendees that have bought properties from us previously. And to look at what that property's worth, have a quick look on, you can go to get some free information like oneroof.co.nz. That will give you an idea of what that property's worth. But certainly, with the sort of capital gains that our clients have got over the last 5, 6, 7, well, actually since they've been with us, dare I say, why not look at selling that property now, taking some of that capital gain out for your own home mortgage, as we always discussed with you, and then be able to look at getting another property. And of course, you won't have maintenance and repair issues as well. Another question here, what about loan to value ratios, Brenda?
Yeah, so, I mean, banks typically, well, the great thing with the new builds is that they all just require a 20% deposit on those, and then 20% deposit or equity on your own home. Existing properties, the houses down the road from you, anywhere, existing rentals, they need 40% equity or deposit in there. So there is quite a difference. And this is just quotes on the LVR rules at the main bank. Yeah.
So, the benefit, there are loads of benefits, as I say constantly with new builds. But two of them, obviously, is the fact that it's only 20% that is guaranteed against your home or another property. So you're not eating into all of your equity, which means potentially you can get another investment. or you just protect your home. But the other thing is that the new build special interest rate you cannot get on an older property as well. And of course, as we always say, an older property, maintenance and repair issues, you've got to keep it for 10 years before you can sell it to not have to pay. You can sell it anytime you like, but if you don't want to pay tax on the profit, it's going to be 10 years that you've got to own it. You're not going to get the best rental return on an older property, and you're not necessarily going to get the best tenants on an older property as well. So, there is a couple of things that I've got to say to our clients to consider.
And of course, it's the tax deductibility benefit as well. There's no tax benefits now on existing homes, but there is, of course, on new builds. So that's a huge thing these days.
Yeah. I've got another question here. What is the estimated capital gain trends for the next 5 years? What is the inflation index trends for the next 5 years? Well, in our cash flows, we look at history, first of all, and property has doubled in New Zealand every 10 years for the last 50, 60, whatever years. We don't show the properties doubling in our cash flows for 12 years. Once the borders open again, we always had before COVID a shortage of housing, and it's just got more and more chronic as the government has not been able to keep to their promises and to build the numbers of housing that they said that they were going to build. The demand for rental is huge, and as I said, when the borders open again, it's going to exacerbate the issues that we've got. So to answer your question, at the moment our inflation rate is quite high. The whole world's going to have to recover from COVID, and it's going to take a lot more than 5 years. Look how long it's taken just down in Christchurch with it's taken 11 years for us to down in Christchurch to start to grow again, and yet it's gone absolutely massive with the cost of not being able to get land, the cost of building. The other point is, of course, when we're looking at the growth of property, the cost of property, and that growth that's happening. I've been quoted by developers and builders throughout New Zealand that the cost of building material is at 12.5% per annum, increase per annum. And that's also that there is the increase on manpower as well. And that's if you can get those materials. So we're actually finding that smaller developers that don't have relationships with the Mitre 10s of this world or whatever do not even get materials. That even the big developers, they can book in materials and can only get a fixed cost for about 12 weeks. That's what with that shortage internationally we're seeing, and it's going to impact on the prices of properties here as we're trying to build to try and keep up with the demand. And that brings on another thing which we will talk about at another time, and that's the sale and purchase agreements. And this is one of the things that we look at for our clients as well. And what it says in the sale and purchase to protect our clients against increases of costs. Any other? Let me just see if there's any other. If there's any other questions. I don't see any at the moment. Well, I want to say thank you so much. We've done an hour, which is very good for us because I could go on forever. Brenda, thank you so much for your coming along and talking. It's always it's great that we work with you, and we've got you on behalf of our clients.
Oh, no, it's amazing. Thank you. I really enjoy helping everyone. I've always loved all the new builds and new build properties, investments, and it's just such a buzz, so easy. And I think it's just really, if you can get your hands on them, which is actually easier said than done sometimes, you really do need to probably jump at the chance, I think, if you can, but you just need the good help behind you.
Yeah. So I'm going to leave up. Thank you so much. I've had some lovely comments here. Thank you for your positive response to tonight's webinar. I'm going to put up our contact details and leave them up there for a while. But I just want to say thank you so much, everyone, for coming along. We've had a good amount of people here this evening, and I hope you've learned something. And hey, it's upwards, and if you know me, my attitude towards investment property and helping people achieve things in their lives. So I want to see you. Make the decision this year. Thanks a lot, everyone.
Bye-bye.
Bye.
See ya.